In this week's video, by comparing 2017 to similar historical profiles, we'll address the question, are stocks overdue for a significant correction? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. After we review the charts this week, it'll be easy to understand how this quote applies to the present day. The secret is being as short-term or as long-term as you can stand, depending on your trading style. We'll kick off the video with somewhat of a generic exercise, but we will quickly tie all of these charts into the present day. If we were taking a technical analysis test and we were presented with these chart patterns, all of them covering 3.5-year periods in history, and the question on the test was, which patterns below look most like this pattern here? And in all cases, we have the 100-day moving average in blue, the simple 200-day in red, and the 300-day moving average in green. If we were trying to answer the question, which of these four charts looks most similar to this chart here, the first thing we would probably notice on the left side of the chart, we have a very, very strong trend, which is indicative of high bullish conviction relative to bearish conviction. One of the ways to discern a strong trend, there's a lot of white space in between the moving averages here. If we go to the far right here, this looks quite a bit different. Notice here, blue never comes down and touches red or green, and in this case, it drops below red and kisses green. The next section of the chart is this consolidation period here. When we have sideways moving averages here, it tends to indicate consolidation, indecisiveness, and confusion. This is a low conviction period. The battle of bullish conviction relative to bearish conviction is very, very even in here. If we compare the charts below to this period here, one of the first things that jumps out, this isn't an indecisive look. This is strong bearish conviction here. This is a steep slope. Steep slopes are conviction, and this is bearish conviction. Notice up here, there's not much white space between the moving averages, and the moving averages, for the most part, look flat in here. It's not really what we have here. We have a lot of white space. Somewhat of a similar situation over here. This is a steeper slope on blue here. This is somewhat of a stronger bearish conviction look than this look here. And after we review the charts and study them, we might draw the conclusion that this chart here appears to be the best fit. A strong bullish trend. A strong bullish trend. A period of indecisiveness and consolidation and confusion. A period of indecisiveness, consolidation, and confusion. And then a breakout, a bullish breakout. Blue exceeds this high here. Then a bullish breakout, blue exceeds this high here. For the same reasons, this chart looks similar, chart A here. The difference is we have a bearish look here, and all of these charts represent 3.5-year periods. So the trend here is much, much stronger than it is here. The rest of the chart looks pretty similar, a strong trend, consolidation, and a bullish break. You can review the charts on your own. The best fit is probably here. This is probably your second best fit. This is your third best fit. And this is probably the worst fit. As you might have guessed if you studied charts, the top chart here is the present day. This is 2013 to February 16th, 2017. So this is as of Thursday's close. This is 1982 to 1985, 1986 to 89, 92 to 95, and 2009 to 2012. If we eliminate chart B because it had the worst fit, it's logical to ask, if these points are similar, what can we potentially learn about the present day? And if you want to examine the 100, 200, and 300-day moving averages from 1982 to 2017, you can see we've highlighted the 3 periods here that are most similar to the present day. If you're relatively new to these videos, a fair question may be, how can you compare February 16th, 2017 to July 1st, 1985, or any of these periods for that matter? There are numerous differences between 2017 and 1985, including significant differences on the valuation front and on the interest rate front. To help answer that question, we really should ask, what do these charts represent, and what do they help us monitor and track? Bullish trends occur when the net aggregate opinion of all market participants is bullish. You get steep and positive slopes when we have high bullish conviction. When the net aggregate opinion of all market participants is mixed, we get consolidation and trendless markets. And of course, when the net aggregate opinion of all market participants flips over to net bearish, we get bearish trends and negative slopes. The key is the charts and the trends and the moving averages are based on all topics, and they cover all time frames. The look of this chart here, the look of this chart here, and the look of this chart here, as well as the look of this chart here, take into account every conceivable topic you can think of, and take into account every conceivable time frame you can think of. Market participants in 1985 considered all the evidence: earnings, potential future earnings, valuations, interest rates, central bank policy, inflation, fiscal policy, regulations, immigration, skilled labor, geopolitical, acts of God, and of course, wild cards. And we do have some wild cards in the present day. The beauty of the charts and the concept of a net aggregate opinion is the look of this chart is based on all of the relevant inputs. Let's put some context around it. Let's assume in 2012, we performed an analysis where we said the look of this chart here is similar to the look of this chart here. You could have made the argument that you can't compare 2012 to 1985 because the fundamentals are significantly different. Now let's assume way back in 1995, we performed an analysis and said 1995 looks similar to July 1st, 1985. Again, you could have made the argument. You can't do that. The fundamentals are significantly different in 1995 than they were in 1985, and that's true. It's also true that the fundamentals are significantly different, or were significantly different, in 2012 than they were in 1985. The point is, the net aggregate opinion and the shifts in the net aggregate opinion are similar in all 3 periods. And the really important point is the outcomes are similar in all 3 periods, regardless of the fact, and a legitimate fact, that the fundamentals were quite a bit different in 2012 than they were in 1995, and the fundamentals were quite a bit different in 1985 than they were in 2012. Given we have similar shifts in the net aggregate opinion in the present day to these 3 periods, let's walk through these 3 periods and see what we can learn. This video is being recorded on Friday, February 17th. There are 317 calendar days left in calendar year 2017. Therefore, if we bought this constructive chart pattern, a similar chart pattern to the present day, on July 1st, 1985, what did the next 317 calendar days look like? Markets never make anything easy on anyone, and in this case, if you bought on July 1st, 1985, from this point here to this point here, the market experienced an 8.48% pullback over the 317 calendar day period from point A to point B. There were additional pullbacks of 3.4, 5.5, 2.5, 5.75, and 4.58. The moral of the story: to capture the 23% gain from point A to point B, you had to withstand volatility. The market model helps us discern between volatility to ignore because it occurs within the context of an ongoing and established uptrend, and volatility to respect where it looks like the longer-term trends are rolling over and we might be entering a new bear market. If we look at closing prices only, we get a little bit shallower look on the pullbacks, but we still had to withstand volatility to get from point A to point B. We also said the present day was similar to July 7th, 1995. Similar situation here. Point A to point B is a 20% gain. To capture the 20% gain, you had to endure numerous pullbacks, including a 6% pullback here and a 5.5% pullback. This is 317 days from July 7th of 1995. And in this case, if we focus on closing prices, it's a little bit shallower look, but similar magnitude in terms of the pullbacks. The other period that we said was similar to the present day, or February of 2017, was October 1st, 2012. In this case, over the next 317 calendar days, from point A to point B, the market gained 16.68%. And to capture the A to B move, you had to withstand numerous pullbacks, including one almost 9% and one of 7.53% here. If we know July 1st, 1985, July 7th, 1995, October 1st, 2012, all three of these periods are similar to the present day, and we also know that we have 317 calendar days remaining in calendar year 2017, it's logical to ask, if I bought this similar looking chart pattern to the present day, or this similar looking chart pattern, or this similar looking chart pattern, what happened in these cases over the next 317 calendar days? To answer that question, we can look at the average path for all three of these cases, and hypothetically, if from February 17th, 2017 to year end, which is 317 calendar days, we followed the average path of these historical and similar cases here, the S&P 500 would move from roughly 2350, and it would start knocking on the door of 2850 by year end. The move from point A to point B would be hypothetically 20%. And as we know, there's no free lunch in the markets. Here's a relatively significant pullback, a lot of volatility, a lot of volatility. The market never makes it easy to get from point A to point B, but that's our goal. We want to capture this 20% return, or at least a high percentage of it. Can't emphasize enough, this is not a forecast. We're not forecasting what may happen. We're trying to understand what volatility might look like in the next 317 calendar days based on these three historical examples. If we understand that, it will be easier for us to classify something like this as volatility to ignore, this as volatility to ignore within the context of an ongoing uptrend. Why is it important to try to discern between volatility to ignore and volatility to respect? Because when you're in an uptrend, the probabilities say when you pull back, you are going to go on and eventually make a higher high, which means if you ignore this volatility and hold your positions, in theory, your profit and loss should be better here than it was here or here. And when you get in these periods marked by strong trends, the odds that your pullbacks and volatility will be followed by higher highs is even more favorable from a risk-reward perspective. There's a lot of volatility after these setups. A lot of volatility, a lot of volatility. But the key takeaway is it's volatility within the context of an ongoing and rising bullish trend. In all three of the cases that we just looked at, the 317 calendar day periods, in 1985, to capture the 23% gain, the total givebacks during that period was over 30%. 1995, to capture the 20% gain, the sum of the givebacks was 34%. And to capture this 16.68% move, here you had to withstand pullbacks of almost 35%. The median and average pullbacks for the period range anywhere from roughly 2.5% all the way up to a little bit over 5%. These are normal and typical givebacks. Sometimes you get larger magnitude declines like this 8.67% giveback. In all cases, the market followed the giveback with a higher high. So from a probability perspective, as long as we have a constructive look and we maintain a constructive look, then volatility for the most part, especially in the short run, will be classified as volatility to ignore. At some point, volatility to ignore mathematically will turn into volatility to respect, and then we have to take action. Why do we want to take action here or here? Because here, volatility is followed by a higher high. Here, the volatility is not followed by a higher high. It's followed by a lower low. So, under our approach, the moral of the story is, if we are not willing to accept and tolerate drawdowns as a normal part of bullish trends, it will be very, very difficult to capture gains between 15 and 20%, no matter how strong the chart patterns are. Our goal during strong trends is to capture a high percentage of the move from A to B. If we hold from A to B, we will probably capture a high percentage of the move. So we know from all of these historical cases that look similar, givebacks were part of the equation. Therefore, if the givebacks that we saw in the next 317 calendar days were similar to the givebacks that occurred in the 317 calendar days that followed these similar and constructive chart patterns, how far might we expect the stock market to fall in calendar year 2017 and still remain within the context of an ongoing and bullish trend? Meaning, if we see volatility to ignore similar to volatility to ignore that occurred in these three periods, how far might the market fall? If we take these declines or givebacks here that we just covered and apply them to the S&P's closing price of $23.51 on February 17, 2017, a 1% pullback would take us to $23.27, a 4% pullback would take us to $22.57, and an 8.67% pullback would take us all the way down to $21.47. To give us some idea of what that might look like, the green givebacks in this table here are shown on this chart here. Thus, if we got a 1% pullback, we might pull back to this blue line here. If we got an 8.67% pullback, we might pull back to this lime green line here. Notice we've added in the 200-day moving average here in red. All of these normal pullbacks, with the exception of the largest magnitude pullback here, would have price, for the most part, remain above the 200-day. Over time, of course, the 200-day is going to rise and price could fall. But theoretically, price would remain above, or at a minimum, we would continue to have an upward sloping and bullish 200-day moving average. It also makes intuitive sense that if these pullbacks occurred within the context of an ongoing and rising bullish trend, then if we applied fibs from the A to B move off the election, here's the election, we have a bullish move from A to B, that these types of pullbacks, for the most part, would fall into the normal retracements within the context of an ongoing uptrend range. And they do. There's one exception, the lime green line here. Therefore, if next week the market starts to fall, we can use these lines as a reference point, and we can use these Fibonacci retracements as a reference point. If price gets down into this area here, the math will start to tell us that maybe we're not in a volatility to ignore situation anymore. As we've noted on Twitter before, it sounds really, really easy to say you're going to ignore volatility when the market is closed over the weekend. It's an entirely different thing to ignore it when you see red on your screen and your positions are falling and you're losing money. Therefore, how do we try to discern between volatility to ignore and volatility to respect? How could trends or the market model help us capture the gain or a significant portion of it from A to B? Well, remember at the beginning of the video, we used very simple moving averages, the 100-day, the 200-day, and the 300-day. If we overlay those moving averages onto this chart, you can see during the entire move from A to B, we have a full bore bullish look with the fastest moving average blue on top, and the slopes of all of the moving averages are positive, and price for the most part during the year remains above all three moving averages. This is a pullback. This is a pullback within the context of an ongoing and established bullish trend. If that wasn't the case, then some of the math in the model would start to deteriorate in a manner saying this is no longer volatility to ignore. And the beauty of the model and the math is the math can't see this emotional swing in price here because the math is using trend following tools like moving averages. This emotional look here is a lot harder to manage against than if we use trends and math as a guidepost. Similar situation in the 1995 example, a lot of volatility with price. If we overlay our 100, 200, and 300-day moving averages, we can see the trends. Despite the volatility, the longer-term trends remained strong, telling us there's a high probability that these pullbacks will be followed by higher highs. And what does the model see when it's just looking at trends? If we remove price, the answer is strong and bullish trends. A lot of white space in between, maintaining a full bore bullish look as far as the moving averages go for the entire 317 calendar days. Similar situation in the 2012 example, over the entire 317-day period marked by numerous pullbacks, the moving averages maintained a try to leave it alone and constructive look. If we remove volatile price from the equation, it gets much, much easier to remove our emotions from the equation. If we can do that, we have a higher probability of capturing a good percentage of the move from point A to point B. If we apply these same moving averages, the 100-day, the 200-day, and the 300-day, to 2017, you can see as of February 17th, here we have a full bore bullish and constructive look. These are strong trends with a lot of white space in between the moving averages. In fact, we recently flipped from a full bore bearish look in here to a full bore bullish look. This looks like a downtrend or an indecisive period here and a bullish turn. Therefore, if we head into next week and every week with that flexible, unbiased, and open mind, and if we take the attitude that we're not forecasting, we're using charts to monitor and adjust if needed. We know we have a similar looking chart pattern here from a net aggregate opinion perspective to the pattern that we had on July 1st, 1985 and July 7th, 1995. Good things happened in the next 317 calendar days in both cases, and in both cases, the observable evidence and the trends were helpful in terms of classifying pullbacks as volatility to ignore within the context of an ongoing and established bullish trend. Which takes us back to our original quote. The secret is being as short-term or as long-term as you can stand, depending on your trading style. What does "as you can stand" mean? It means that it's not particularly easy to hold during the inevitable givebacks that occur within the context of a bullish trend, which is why we will continue to focus on using the model hard data relative to the intermediate and longer-term trends, rather than the emotional swings and roller coaster situation that we get if we're looking just at price. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.